Today I got Richard Duncan on the line. Richard Duncan, I'm sure you've heard of the name before, is author of three books on the global economic crisis called The Dollar Crisis, Causes, Consequences, and Cures, which forecasts the global economic crisis of 2008. And he began his career in equity analysis in Hong Kong in 1986, advised a lot of equity firms, and he also worked as a consultant for the IMF in Thailand during the Asia crisis. Today, he is now the publisher of the video newsletter MacroWatch, which can be found on his website. We'll talk about that at the end. I'll do a little screen share. I bought into his program, currently a subscriber, and it's great to finally talk to you, Richard.
Thanks, Lane.
So a lot of the listeners today are pretty astute and read the news on this alternative mainstream news. Get back to pre-2000.
Okay, so I was very lucky to live in Thailand during the first half of the 1990s. I started working in Hong Kong in 86 as a securities analyst, and before long was promoted into being head of research for James Capel Securities in Thailand in 1990. And at that time, Thailand's economy was growing at 10% a year. The stock market was really booming, had a very large research department. There were 10 analysts reporting to me, another 10 support staff. So we had a very good understanding of exactly what was going on in Thailand's economy and all the Thai companies at that time. And I stayed in Thailand at that time 6 years. And the first 3 years, it was truly something of an economic miracle. But by 94, it was clear that something was not right. It was blowing into a bubble. And everyone should have been able to recognize that. Everywhere you looked out the window, there were hundreds of cranes on the horizon building high-rise buildings. And it wasn't just the property sector that was experiencing this extraordinary boom. Because we were doing research on all the listed companies, we could see that same sort of thing was happening with all the major industries across the country. But the problem was there just wasn't going to be enough purchasing power in Thailand, given the low income of most people, to absorb all of the capacity that was being produced. And so I started writing quite bearish reports on the economy, bearish meaning predicting that the economy would only grow by 7% a year instead of 10% a year. It did continue to boom and didn't bust until 1997. But when it did, the Thai stock market fell 9% in dollar terms. And so I always say I had my education in bubblenomics in Thailand. I was very fortunate to be here and watch this extraordinary boom and bust cycle. And that's where I understood the mechanics that drive these economic cycles and the role that credit plays. So after that, I moved to Washington and worked for the World Bank in 1998, 99, and 2000. And when I was there, the NASDAQ bubble was going on. So I saw another bubble there. And so eventually, after watching one bubble after another, I wrote my first book, which was The Dollar Crisis. It was published in 2003. The theme of that book was that the global economy was being destabilized by giant U.S. trade deficits. The trade deficits were destabilizing the global economy. They blew the trade surplus countries like Japan and later on the Asia crisis countries. All the countries that had trade surpluses with the U.S., those countries blew into bubbles, and they ultimately all popped. Under the gold standard, trade between countries had to balance, because if one country had a big trade deficit with another country, the deficit country had to pay with its gold. And before long, it would run out of gold. And so it couldn't continue having these large trade deficits. For example, in the 19th century, if England had a very big trade deficit with France, then England's gold would have been literally put on a ship and sent over to France. So France would have had more gold. France's economy would have boomed. They would have had more employment. But the opposite would have happened in England. England would have lost gold. So credit would have contracted and the economy would have gone into severe recession and unemployment would have gone up. So pretty soon the poor unemployed English would stop buying so many expensive French products and the rich French would start buying more cheap English products and the trade would come back into balance. That's the way the gold standard and the Bretton Woods system worked. Trade between countries balanced. There was an automatic adjustment mechanism that made trade balance. But once the Bretton Woods system broke down, it didn't take long for the United States to discover that it could buy things from other countries and it didn't have to pay with gold anymore. it could just pay with paper dollars or treasury bonds denominated in paper dollars. It started running these massive trade deficits, initially with Japan in the 1980s. Japan had the trade surplus. It was getting paid with foreign money, dollars came flooding into Japan. And these dollars went into Japan's banking system and they caused the credit to expand very rapidly. And as the credit expanded, Japan's economy boomed. Unlike England, the US economy didn't deflate because the US wasn't paying with a limited amount of gold. It was just paying with essentially paper money or treasury bonds. The Japanese economy boomed until the stock market was trading on a 100 times PE multiple by the late 80s. And the gardens around the Imperial Palace in Tokyo, just that park was more valuable than all of California. Then it all blew up in 1990, the bubble popped, and the great Japanese bubble deflated. And Japan's economy is no larger today than it was in 1993. So that's what we've seen again and again. These trade imbalances, countries with the surpluses blow into bubbles. So afterwards, we had Thailand, Malaysia, Indonesia, and Korea in 1997. And then more recently, China's economy has been blown into an enormous economic bubble in the same way.
So
The
basically,
other,
just so people, we don't lose anybody here, basically, United States, we're the consuming economy. We buy a lot of stuff for a lot of goods and we ship out United States dollars.
and within the United States, the thing that gives us our purchasing power, credit growth, has been driving economic growth in the US for decades. For example, total debt and total credit, they're the two sides of the same coin. When I talk about total credit, what I mean is all the debt in the country: government debt, household sector debt, corporate debt, financial sector debt, all the debt relative to the size of the economy, debt to GDP. From 1950 until 1980, this debt to GDP in the US was about 150%. Starting in 1980, the debt or credit growth accelerated, and the ratio of debt to GDP expanded from 150% up to 350% in the US. And so, as the debt and credit expanded, that gave individuals more money to spend. They could borrow and spend. And the more they spent, the stronger the economy became. And as long as the credit kept expanding, then the US economy boomed and it pulled in imports from the rest of the world. And so at the peak in 2000, the US trade deficit, the current account deficit, hit $800 billion that one year. That was the amount that the US went into debt to the rest of the world, buying things essentially on credit. That was $2 million a minute that the US was going into debt. And of course, that meant the rest of the world had an $800 billion trade surplus with the United States. They grew $800 billion more than they would have if trade had been balanced, as it always had been in the past. So this arrangement completely destabilized the global economy. And when the American households became so heavily indebted, they couldn't repay the interest on their loans anymore in 2007 and 2008, then this whole bubble began to deflate and the households started defaulting. The financial sector effectively went bankrupt, and we came very close to collapsing into a new Great Depression. And the only reason we didn't is because this time the government intervened so aggressively. In the 1930s, when another big credit bubble popped, the government really didn't know what to do, and they didn't do very much. They more or less just sat back and let market forces work. And market forces did work, but unfortunately, when market forces were through working, the economy was 50% smaller than it had been in 1929. This time, when the bubble popped, the government, rather than letting market forces shrink the economy by 50%, intervened with trillion-dollar budget deficits. And the central bank, the Fed, helped finance these enormous budget deficits by creating $3.5 trillion through quantitative easing. And at the same time, other governments around the world did similar things. The Bank of England had quantitative easing. The European Central Bank did, and also the Bank of Japan. And meanwhile, China's central bank also firing on all cylinders.
That's 25 plus hours of group coaching and masterminding. I know what you're thinking. Not another flippin' Facebook group. This one's gonna be different, more intimate, exclusive, and no cheapskates or shady vendors in it. I've been coaching individual clients over the past couple years, and I figured out what you guys need and a way to provide it in a cost-effective way.
this coordinated global policy response involving massive government intervention and huge money creation by the central banks. This reflated the global economy and it prevented a new Great Depression. And so that's pretty much where we are now. Because of the government intervention, the bubble has been reflated. So it's important for everyone to understand that our economic system is not really, shouldn't be described as capitalism. Capitalism was an economic system in which the government played very little role. It was an economic system that was driven by investors. Businessmen would invest. Some of them would make a profit. They would save that profit and reinvest it. So the growth dynamic was driven by investment and savings. But that's not how our system works at all anymore. Our economic system is driven by credit creation and consumption, and more credit creation and more consumption. And here the government plays a leading role. So you look back to 19, anytime that total credit in the US grew by less than 2%, this is adjusted for inflation to compare apples with apples. Anytime credit grows by less than 2%, the US economy has gone into a recession. That happened 9 times between 1950 and 2009. And if we have a significant contraction in credit, then the economy goes into depression. So I call this economic system creditism rather than capitalism, because the key driver is credit expansion. The problem is in 2008, we reached the point where the private sector, households and businesses, couldn't continue borrowing enough to drive the economy. And so the government had to step in. And since then, government debt has increased by something like $12 trillion between 2008 and now. And that's what's driven the economy. But even that, even during the last, say, 8 years, credit growth has just barely been above 2% a year, which I call the recession threshold. That's kept us out of recession, but the economic growth has been weak. And so we've had to supplement credit growth with a new economic growth driver, and that has been asset price inflation. The Fed is very concerned about the stock market and the property market. So the net worth of the American households, in other words, all the Americans, their net worth, that is,
Most people have their money in the stock market, mutual funds, or 401ks, or the pension.
right, that's right. And also, of course, in their homes and in some cases, other property. So the wealth, the net worth of the Americans, if you take all of their assets minus all of their debt, it's now $100 trillion. This is up 82% from 2009. It's up $49 trillion from the low level that it hit in 2009. The policy of the Fed has been to push up asset prices in order to create a wealth effect, push up the stock market, push up the property market, so that the Americans would have more wealth that they could borrow against and spend. And that has boosted consumption, and that has boosted economic growth in the US. So we've reached the point now, though, where the Fed has effectively become a hostage to the stock market. The Fed just simply can't allow the stock market to fall, because if it falls, then the wealth will be destroyed, consumption will fall, the economy will go into recession, and credit growth is already too weak to drive the economy. So every time the stock market starts to have a little correction, as it did during December and again in May, that has forced the Fed to radically change its policies. Up until December, the Fed was telling us that they were going to continue hiking interest rates and also carry on with quantitative tightening. In other words, the opposite of quantitative easing. With quantitative easing, the Fed created money and used it to buy bonds, to push up bond prices and push down interest rates. With quantitative tightening, they've been doing the exact opposite. They've effectively been destroying dollars and selling bonds, which tends to push bond prices down and interest rates up.
How that affects us in real life is our interest rate now, the tightening is supposedly going up, very slow kind of process.
Yeah, so when the stock market started falling in December, the Fed had to say, okay, we've changed our policy. We're not going to keep tightening interest rates, and we're going to end quantitative tightening much sooner than we said we were going to. And then, so the stock market recovered, but then by May, it started falling again. And so the Fed has more or less been forced to say that they're going to begin cutting interest rates. And they're going to cut interest rates later on this month at the end of July. So it's important to understand that Fed just simply can't allow the stock market to fall, because if it does, the US could go back into severe recession.
The analogy that comes to my mind is somebody running down the hill. As long as you can keep on your feet, you'll be fine. But as soon as you trip and fall, you're taking a tumble harder and harder as you keep going faster and faster.
And so their job is being made more difficult in some respect by this U.S. China trade war. Up until then, it had been the U.S. economy and U.S. imports that had been driving the global economy. But after the crisis, the U.S. imports were no longer growing as quickly. China actually became the global growth driver. Because China's government invests so aggressively, their economy continued to grow very rapidly. And of course, everyone understands that in percent terms, China's economy has been growing much more quickly than the US economy for decades. But only in the last 8 years or so, in dollar terms, China's economy has grown more than the US economy has in absolute dollar terms now for something like 6 out of the last 8 years. So the Chinese economy became the new economic growth driver for the world. China's economy was already facing serious trouble before the trade war started. They have an economic bubble. They have invested so much in property and across all of their industries that they have excess capacity of everything. For instance, in their cement industry, they say that in just 3 years between 2011, 12, and 13, China produced as much cement as the United States did during the entire 20th century. How do you keep growing your cement industry when you are already producing excess cement on such an extraordinary scale? And it's not just the cement industry, it's steel and all their other industries as well. So they've hit the point now where they just have so much production capacity. People in China don't earn enough money to buy it all. And the rest of the world, now there's a growing protectionist backlash against China, and
I think
trade tariffs are going up.
the big thing that we see a lot in headlines on social media is like ghost town, right? We create these nice properties, but no one can afford the dang thing.
That's exactly right. One Chinese professor told me a story. He said he was taken to one of the mid-sized Chinese cities with only 1 or 2 million people in them. And he was shown a beautiful new bridge that had just been completed. The thing was, there was no river. The bridge had been built in a place where they were planning to build a river there at some point in the future. But at this point, there was a bridge, but there was no river. That just goes to show you what kind of trouble China's economy is facing. They have grown in the past through export-led growth, exporting mostly to the US, and investment-driven growth. They've reached the point now where the US, the whole world is just not large enough to continue absorbing more and more Chinese exports every day. China's trade surplus with the United States is $1 billion a day, more than that now. China's growth model, its economic growth model, is in crisis. They can't continue growing through exporting to the rest of the world because the rest of the world is saturated. They can't sell their goods internally because the Chinese people at home don't earn enough income. The disposable personal income per capita is something like $10 a day in China. So rather than being a growth driver, they're actually being a drag on global growth.
So one thing I
China's
like
economy.
about the MacroWatch outline for the listeners here is, I think like 2008 crisis in America, it was told to us in the Big Short movie, whether it's right or wrong, that it was a United States internal problem, which it was. But I like how you outline how there was a global issue happening. And is this very similar to what's happening in China? There's obviously this global trade war happening, but China is having their sort of internal problems with all the, I don't know what you'd call it, non-production and ghost towns, just like how the United States was having internally. Is it the same thing? It's like sticking a stick in a bite.
China was going to stop growing, I believe, and have a severe recession, even had there been no trade war. But now with this trade war making things worse, it's accelerated China's economic crisis. This is very important, not only for China, but because the global economy is slowing down with China. That's why global interest rates are falling. There's not enough demand for money. Businesses don't want to borrow money because there's no place to invest it and make a profit. With insufficient demand for money, of course, interest rates are the cost of renting money. And if there's a lot of demand for money, then interest rates should rise. But now there is not a lot of demand for money because there are very few viable investment opportunities in the global economy. So interest rates all around the world are falling. In fact, their negative interest rates, total of $13 trillion of bonds around the world now actually have negative interest rates. In Germany, for instance, if you buy a 10-year German government bond, the yield is negative 35 basis points. And in Japan, the yield on a 10-year Japanese government bond is negative 15 basis points. It means that anyone who buys those bonds and holds them to maturity, they're guaranteed to lose money. The reason interest rates are so low, one reason is the one I've just described. The global economy is weak and there's weak demand for money. But at the same time, central banks have created so much money through quantitative easing, not only in the US, but around the world, that the supply of money has grown. So you have a lot of money available and not a lot of demand for the money. So mortgage rates have come down in the US, and that's helped the property market. That's helping businesses become more profitable than they would have been if they had to pay interest rates above 3%, for instance. So the lower interest rates have temporarily benefited the economy, and they pushed up the stock market because the lower interest rates go, you can only earn such a small amount on your deposit in a bank. You don't mind taking your savings out of the bank and put them into the stock market. So the lower the interest rates have gone on the 10-year government bonds, that's another reason the stock market is at a record high. But it's a delicate balancing act because the Fed has to keep the stock market moving higher, or at least it has to prevent it from going lower. There's a limit as to how much monetary policy can accomplish by itself. What would be very helpful and what we're likely to see more of is the government spending more fiscal stimulus. The US budget deficit has become much larger again. It's back over $1 trillion. And that's helped the economy. And it's going to take more of that, frankly, to keep the economy growing. So what people are generally told that the US has a capitalist economy, but in reality, the economy at the macro level is government directed through a combination of central bank monetary policy and fiscal policy. And what it's going to require going forward, if it's going to remain out of crisis, it's going to require more government borrowing and spending. And it's also going to require more paper money creation by the Fed. Now, in the past, this would have led to extremely high rates of inflation, the way that it did in the 1970s. The reason the Fed and the other central banks have been able to create so much money over the last decade without causing high rates of inflation is because of globalization. Because globalization is extremely deflationary. Instead of having to hire someone in Michigan and pay that person $200 a day to work in a factory, you can hire someone in Western China or Central China and pay that person $10 a day, or someone in Vietnam and pay them. There are 2 billion people in the world living on less than $3 a day. So suddenly we have essentially an infinite supply of low-cost labor. And that has been pushing down wage rates in the United States and the developed economies. And it's also been driving down the cost of manufactured goods. And these deflationary forces from globalization have completely offset the inflationary forces that would normally be expected from paper money creation. And so we have found ourselves in a unique moment in history, in fact, where what we've seen over the last 10 years is the US government's budget deficit or its debt has expanded by $12 trillion. And the Fed helped pay for that by creating $3.5 trillion out of thin air and buying government bonds through quantitative easing, all without creating any significant inflation at the CPI level whatsoever. As long as globalization persists, we're not going to have high rates of inflation at the CPI level. And it's going to take more fiscal stimulus from the government and more quantitative easing from the Fed to keep the economy growing. Common sense suggests this is somewhat alarming, but whether you like the idea or not, you should recognize that this is the most likely scenario of what is going to happen. You might prefer that play out in some other way, but it's probably not going to. If you want to understand the financial markets, you have to understand the reality rather than ideally what you would like to see.
When I was getting my first few rentals, I found networking at a local REI club absolutely a waste of time. Most of the people you network with, especially in random networking events, will not lead to anything. The running joke amongst sophisticated investors is that the local real estate club is the worst place for us passive investors to find peers because it's just a bunch of broke people. That's why people are seeking real estate advice to get unbroke. For the same reason, I am turned off by the 10x Grant Cardone followers because they are really a ninja in disguise. No income, no job, no asset.
by creating $3.5 trillion out of thin air and buying government bonds through quantitative easing, all without creating any significant inflation at the CPI level whatsoever. And so this is what we're going to see more of in the future. As long as globalization persists, we're not going to have high rates of inflation at the CPI level. And it's going to take more fiscal stimulus from the government and more quantitative easing from the Fed to keep the economy growing. Now, but whether you like the idea or not like the idea, you should recognize that this is the most likely scenario of what is going to happen. You might prefer that play out in some other way, but it's probably not going to. If you want to understand the financial markets, you have to understand the reality rather than ideally what you would like to see.
Where is this kind of coming to a head with the United States putting tariffs on China imports?
This is a real worry, of course, because on the one hand, if we have an all-out trade war with China and globalization breaks down, then we won't have access to cheap labor. And in that case, if the government runs a very large budget deficit and the Fed creates a lot of paper money, and we don't have globalization anymore to keep the deflationary forces flowing, then we're going to end up with high rates of inflation. And if inflation goes up, then of course interest rates in the US would move much higher. And if interest rates move much higher, then the stock market would crash and creating a very negative wealth effect. And at the same time, credit would contract because it would be less affordable. And that would also cause a very severe economic crisis. So the greatest danger facing our future is the possibility that we would have higher inflation, globalization collapses. On the other hand, it is true that China is a threat to the future of the United States in that it is growing so rapidly, it is going to soon overtake the United States as the most powerful economy and technological and military superpower. Current trends continue. And it is true that they have manipulated their currency for decades. And at the same time that they forced technology transfers and protected their markets unfairly. So that can't be allowed to continue either if the United States is going to retain its global preeminence and security. So we need to find a strategy that will allow us to continue to have globalization, but to allow us to grow rapidly as well. I think the best strategy would be for the United States government to borrow and invest in new industries and technologies very aggressively. I believe the government is going to continue having these massive budget deficits in any case. We need to have a public discussion about how the government is going to spend this money. They could spend the money investing in 21st century technologies. They could invest aggressively in artificial intelligence, genetic engineering, biotech, nanotech, neurosciences, robotics, and green energy. On such an aggressive scale, it would induce a new technological revolution, and it would allow the United States to continue to maintain its global preeminence. It would make the economy grow much faster, and it would create technological miracles and medical marvels that would improve the health and being of not only every American, but everyone alive. In this, where we find ourselves in this unique moment in history, where the government really has no choice but to continue borrowing and spending, and the Fed can finance this through paper money creation. This gives us an opportunity to invest in these new industries on a very aggressive scale. And if we do that, not only will we continue to keep the economy out of depression, but as I said, we will induce a technological revolution that will vastly improve human well-being.
So I think the average real estate investor is out there thinking to themselves, it all sounds like Star Wars to them. It's something outside even our country. We've been told to think that market cycles last anywhere from 8 to 12 years. Is that 8 to 12-year rule still apply?
So yes, this is the longest expansion of the economy ever. And it hasn't been a very strong expansion. Normally, after you have a recession, the bounce back is a few years of very rapid economic growth, which we've never had in this expansion. But the only reason we had any bounce back at all is because of government intervention with these huge budget deficits and this extraordinary amount of paper money creation. So right now, the total debt of the U.S. government is just a little bit larger than the U.S. economy. Government debt is about 106% of GDP, so just a little larger than the economy. So this is almost as high as it was at the peak of World War II. But that's just not true. Japan, for example, the Japanese economy went into crisis in 1990. And at that time, their government debt to GDP was 60%. Since then, almost every year, they've had very high budget deficit, and their government debt is now 240% of GDP. So the US economy is roughly $20 trillion in size. So that means the government debt is something like $20 trillion, let's say. So the US government could borrow and spend an extra $20 trillion before it even 200% government debt to GDP, whereas Japan's already now 240. And of course, if the government borrowed and spent that much money, the economy would grow by 10% every year. So we would never get to 200% debt to GDP. We have the potential to continue growing government debt realistically. Again, I know many of your listeners must be cringing at the thought, but there is nothing to stop US government debt from continuing to grow. And so the sensible approach is just to come up with a good strategy on how to use this money that the government is going to borrow rather than using it wastefully. They say that Japan wasted all this government money by building bridges to nowhere and paving the Japanese countryside with cement. They had understood in 1990 how much government debt their government was going to take on over the next 30 years. They would have come up with a brilliant plan on how to invest that money in new industries and technologies, but they didn't. So the US can learn from the Japanese experience. Our government debt is going to continue to grow. What we need to decide is how to use this debt to improve the well-being of everyone in our country by investing in new industries and technologies. That's my recurring theme. From a business perspective, I think it would probably be a mistake at this point to assume that the end is nigh and to bury your gold in the backyard, for instance, because the end is not nigh. This is going to continue for a long time. We're not on the brink of bankruptcy. And as long as there's no inflation, this can go on for decades. So the biggest threat to our prosperity, or visible threat at least, is globalization completely breaks down and trade tariffs go up around the world. And then we don't have the deflationary forces from globalization and we get higher rates of inflation. And then all bets are off. In that case, we could have a very serious depression. But until that happens, I think people should not fear that the US government is on the verge of bankruptcy anytime in our lifetime.
Unless something trips us up for the short term and puts us into another little recession, like a China trade war going haywire or something like that.
And of course, all kinds of things that could go wrong. The China trade war, our trade war, in fact, has already become something of a Cold War, and not inconceivable that the Cold War could become a hot war. In that scenario, certainly all bets are off and everything could go terribly wrong.
Where is this trade war going? Right now, United States is doing tariffs on import now. I guess putting yourself in the perspective of the Chinese, it's basically on them, or is it on the United States to propose an end to this?
My interpretation of what is happening is that, of course, at first, when President Trump was running for office, we couldn't know for sure whether he really meant what he was saying about China or not, stopping China. And the first year they focused on cutting taxes. And once that was done, though, then he did turn his attention to China and started to ramp up this trade war gradually and then more aggressively. And we've seen Pence called China out on a broad number of fronts, not only economic, but political and across the spectrum. We know that President Trump is being advised by Peter Navarro and other China trade hawks. Peter Navarro has written a book called Death by China and a number of other books, similarly alarming titles. And these people really do believe that China is a grave threat to the future of the United States. And they want to stop China's rise. So it's become clear that this trade war is not just about trying to balance trade, but it really does seem to be about trying to stop China's growth and prevent China from overtaking the United States. So right now we've reached the point where we have tariffs, 25% tariffs on more than $300 billion worth of Chinese import. And it looks like there is a pause. So we may see some sort of truce where things don't become worse, but things don't become better. If he is reelected, I would imagine that he will further intensify the pressure on China and continue hiking rates tariffs in order to damage China's economy. And China is not going to give in. They can't comply with what he's demanding. They're not going to do that.
It's like starving or smoking out China, right? At some point, they're not in the strongest position internally to outlast these kinds of trade demands.
They're not likely to cave in because no one in China has to stand for election ever. So Chinese people can endure a whole lot of pain before it would effectively take a revolution to force the Chinese government to do something it doesn't want to do. And that's not going to happen. Extremely unlikely. So they're not, I don't think they are going to give in. But if the danger is that, so the trade war does intensify, we put up higher tariffs. On the one hand, there's the risk that China's economy will slow down, go into significant recession, which will drag the world into significant recession. That's one danger. In that case, we'd see low interest rates, perhaps. But the other danger is that if you put trade tariffs on all of Chinese goods, that's going to push up, of course, the price of Chinese goods that are sold in Walmart. And that will push up interest rates, and that crashes the U.S. economy. It could play out badly either way.
Or maybe they cancel each other out. Is that a possibility?
At the moment, that seems to be what has been happening. We've had these higher tariffs, so it's going to be interesting to see what the knock-on effect of that is on prices in Walmart, on consumer goods. If China's economy goes into a severe crisis, there's no telling how they will respond. For instance, we should keep in mind some history lessons. In June of 1941, the United States put an oil embargo on Japan, and 6 months later, Japan attacked Pearl Harbor. There is a risk U.S. measures drive China's economy into a severe crisis, that they will respond in ways that don't only involve economics.
So I guess many things ahead, and other than the China trade war, what's the kind of the secondary bump along the road that you're seeing coming up that could derail this party train?
So rather than going down this road where we force China's economy into crisis with severe global repercussions, it would be a better strategy for the U.S. to borrow and invest in new industries and technologies on a very aggressive scale so that we can rev up our economy. And rather than, if we're afraid that Huawei, the world leader now on 5G technologies, we're doing all this because we're afraid China is going to overtake us. The reason China's potentially going to overtake us is because their government invests much more in new industries than our government does. But that's the problem. The solution is for our government to invest much more in new industries than their government does. And then we can solve this worry and avoid a global economic crisis and potential military crisis. So that's the solution and the hope that I think the approach that I advocate. Now, I think the most important thing for investors to understand is that in this modern world where money is no longer backed by gold the way that it was up until the early 1970s, in this new system we live in, creditism, credit growth drives economic growth. If we don't have enough credit, the economy goes into recession. Liquidity is the thing that determines whether the asset prices, the stocks and the property go up or down. What do I mean by liquidity? Essentially, it's the amount of money that the central banks create. And so it's credit growth drives economic growth. Liquidity determines whether asset prices move up or down. And the government is pulling the levers, is doing everything that it can to control credit growth and liquidity in order to make sure that the economy doesn't spiral into a new depression. Those are the things that I always focus on in my work with MacroWatch. I monitor credit growth, liquidity, and government policy to see how these things are going to impact the economy and asset prices in the weeks and months and years ahead.
You got to pay to play and to get some of this better information out there, as opposed to, I think too often out there, people are skimming on like the free stuff, that free 1 hour that you're getting, and same bunch of garbage again and again, as opposed to the good stuff here.
Every 2 weeks, I upload a new video, and plus people who subscribe, they have immediate access to all of the videos in the archives. This MacroWatch was launched in 2013. So there are now more than 50 hours of videos in the archives that subscribers have immediate access to. And I've also made 4 courses. The first one was called Capitalism in Crisis. The next one is called How the Economy Really Works. There's one on monetary policy. and there's one on China's economic crisis. So each one of these several hours of videos explaining all of these very important subjects that drive our modern economic system and our wealth.
And I think what I like about it, there really isn't too much stuff. It's more quality over quantity. Now that I don't have a day job, I can do this every week. But this is the opposite of your everyday podcast. We don't got time for that garbage. We want good stuff. And I think I had up here a little while ago, you had it arranged by date. I think it's a good amount of quantity that you're putting out here too. So what would you say? Like, I just joined this past month. Obviously, I'm not going to spend 50 hours, not even 8 hours watching these videos. What would be the best way to just jump in and start absorbing? I always tell my guys in my mastermind, we're going to do the minimum effective dose. You're busy working professionals. What's the best, your recommendation to tackle this?
MacroWatch really is designed to teach people how the economy really does work now in the 21st century. It doesn't work the way it did in the past when we were on a gold standard. All of the classical economic theory that is still being taught in the universities doesn't explain how the economy works anymore. MacroWatch does. And if you are a real beginner at economics and don't really know very much about it at all, I would suggest beginning with the course called How the Economy Really Works. Economics is not rocket science. You don't need to know calculus and physics to understand how the economy works today. It's just not that complicated. And I explain it in very simple terms. If you're a beginner, start with the course called How the Economy Really Works. If you're quite knowledgeable, what I would suggest is beginning with the course called Monetary Policy. I'm very proud of this course in particular. I've been working on a new book, and as I have gone along, I've made these courses on the subject the book was going to be about. For instance, one of the videos is a history of U.S. monetary policy. This effectively describes how the Fed has conducted monetary policy since it was created in 1913. It covers 7 different periods by looking at the Fed's balance sheet, how the changes in the Fed's assets and liabilities explain how the Fed has conducted monetary policy. If you watch this course, you will be an expert in U.S. monetary policy. It's not only in this course, we also cover monetary policy in China, Europe, and Japan. So you will have a comprehensive understanding of global monetary policy, and global monetary policy is now the most important force driving the global economy. It's the most powerful policy tool that governments have to control our economic system. And that's what they're using to make sure our economy doesn't collapse.
As always, do your research on your own. If you want to get your own subscription to this, I think it's what, $500, but you've got a little discount for listeners for richardduncaneconomics.com and use coupon code LANE, Lane.
If you go to richardduncaneconomics.com, hit the sign up now tab, and it will ask you for a coupon code. If you type in Lane, you can have a 1-year subscription for $249. That's a 50% discount. You can become an expert on how the economy really works now, and you will then be in a position to judge for yourself how new developments are likely to affect the stock market, the property market, commodities, currencies, gold, oil, your assets.
Thanks for coming on, Richard, and breaking some of this stuff down.
Thanks, Lane. It's been a pleasure talking with you. I've enjoyed the conversation. Let's do it again sometime.